Have you ever wondered what could cause the stock market to take a sudden dive? It's a roller coaster ride that even seasoned investors find hard to stomach. This time around, the culprit was an unexpected surge in the January Consumer Price Index. The numbers came in hotter than anyone had anticipated, forcing investors to rethink their expectations for a series of quarter-point rate cuts by the Federal Reserve, which were expected to begin as early as March or May. This sudden change in the economic landscape caused a sharp tumble in the market. On a single Tuesday, the Dow dropped over 500 points, a decline of 1.4%, marking its worst day since March of the previous year. The S&P 500 also took a hit, losing 1.4% of its value, while the Nasdaq Composite lost 1.8%. The losses were significant, leaving investors wondering what was really driving a bull market that had propelled the S&P 500 and Dow Industrials to multiple record highs in 2024. But the market, being the dynamic entity it is, didn't stay down for long. Over the next 2 days, stocks began to claw back the losses from that tumultuous Tuesday. By Thursday, the S&P 500 had made its 11th record close of 2024. Why the swift recovery? Well, as Tim Hayes, the chief global investment strategist at Ned Davis Research, put it, a mere delay in rate cuts isn't the catastrophe that Tuesday's knee-jerk reaction implied. Hayes distinguishes between doubts about the timing of something bullish, like rate cuts, and fears about something bearish, such as resurgent inflation or collapsing economic growth. In this case, the market's reaction was more about the former than the latter. In just 2 days, however, the market began to show signs of recovery. It's a testament to the resilience of the market and its ability to bounce back from sudden shocks. But as we'll see in the next scenes, this resilience doesn't make the ride any less bumpy. So, what does it take for the stock market to bounce back from such a significant fall? Well, let's dive into that. Firstly, let's consider rate cuts. The market took a hit when the January Consumer Price Index came in hotter than expected, causing investors to reconsider expectations for as many as 6 quarter-point rate cuts by the Federal Reserve. This led to a steep one-day drop. However, over the next 2 days, stocks clawed back most of the losses, with the S&P 500 even ending Thursday at its 11th record close of 2024. Now, you might be wondering why stocks recovered so quickly despite the delay in rate cuts. According to Tim Hayes, chief global investment strategist at Ned Davis Research, a mere delay in rate cuts isn't the catastrophe that the market's knee-jerk reaction implied. He argued that doubts about the timing of something bullish, in this case rate cuts, should be distinguished from fears about something bearish, such as resurgent inflation or collapsing economic growth. The key takeaway here is that it's not just about the rate cuts themselves, but also about how the market perceives and reacts to these changes. It's important to differentiate between the timing of bullish events like these rate cuts and actual bearish concerns that could significantly impact the economy. Another important factor that contributed to the swift recovery was the weaker-than-expected January retail sales report. This report seemed to soothe fears that a surging economy would spark a renewed inflation wave, and as a result, the market enjoyed a 2-day bounce. However, the market's recovery wasn't complete. Stocks pulled back slightly after another hotter-than-expected inflation reading from the January Producer Price Index. But even with this setback, the Dow was only down 0.1% for the week, while the S&P 500 shed 0.4%, ending a run of 5 straight weekly gains. In fact, by the end of the week, the market had already begun to recover most of its losses. The market's ability to bounce back so quickly is a testament to its resilience, and a reminder that even in the face of unexpected setbacks, it's possible for the market to recover and continue its upward trajectory. But why does the stock market react so swiftly to economic data, you might ask? The answer lies in the market's inherent nature. The stock market is like a living organism, reacting in real time to stimuli from the world around it. Economic data, such as inflation rates and retail sales reports, are among the most potent of these stimuli, and the market's response can often seem reflexive, like the knee-jerk of a patient under the doctor's hammer. This knee-jerk behavior is particularly noticeable when the data runs too hot or too cold. An inflation rate that's higher than expected, for instance, can send the stock market spiraling down as investors fear the impact on corporate profits and consumer spending. On the other hand, a retail sales report that's weaker than anticipated can trigger a rally as investors anticipate potential rate cuts by the Federal Reserve. But it's crucial to understand that these swift market reactions don't necessarily indicate a new trend. They are responses to the immediate stimuli and can fluctuate with each new data release. It might take a few more data releases to establish a new trend, or to confirm that the week's data was just a bump in the road. For instance, let's revisit the recent market behavior. The hotter-than-expected January Consumer Price Index sent stocks tumbling, but they quickly clawed back as investors realized that a delay in rate cuts wasn't the catastrophe it initially seemed. Then, a weaker-than-expected January retail sales report sparked a two-day bounce, only for stocks to pull back again after another hotter-than-expected inflation reading. This back and forth might seem erratic, but it's all part of the market's knee-jerk behavior. The market reacts, then reassesses, then reacts again, constantly adjusting to the ever-changing landscape of economic data. Despite the market's initial reaction, it's important to remember that an expanding economy that doesn't fall into recession should perpetuate this bull market. So, while the market's knee-jerk reactions can make for a bumpy ride, they're just part of the journey. What does the bounce in stocks and the fall of the SIBO Volatility Index, VIX, tell us? Well, this combination is quite enlightening. The VIX, often referred to as Wall Street's fear gauge, measures expected S&P 500 volatility over the coming 30-day period. When the stock market took a dive, the VIX broke above 15, ending a streak of 63 sessions below that threshold. However, it didn't stay there for long. By the end of the week, it had descended to 14.41, indicating a significant pullback. Now, this is where it gets interesting. If equities had been driven lower by rising fear, in this case the fear of renewed inflation, we would not have seen the recovery of the last 2 days, nor would we have seen the VIX drop back so quickly. Tim Hayes, the chief global investment strategist at Ned Davis Research, argued that stocks recovered because a mere delay in rate cuts isn't the catastrophe that the market's knee-jerk reaction implied. He wrote, "Doubts about the timing of something bullish like rate cuts should be distinguished from fears about something bearish, such as resurgent inflation or collapsing economic growth." This perspective aligns with the bounce in stocks we've witnessed. The market's reaction to the hotter-than-expected Consumer Price Index was swift and severe, but it was also short-lived. Over the next 2 days, the stocks clawed back all or most of the losses, with the S&P 500 SPX ending Thursday at its 11th record close of 2024. However, it's not all smooth sailing. Despite the bounce in stocks and the fall of the VIX, there are still uncertainties looming over the market. The hotter-than-expected inflation reading from the January Producer Price Index has left some investors feeling uneasy. So, while the market has shown resilience in the face of these challenges, it's clear that the fear of renewed inflation is still causing some jitters. The test will be how the market responds to any further data that might suggest a new trend, or just another bump in the road. However, rising fears of renewed inflation are still causing some jitters in the market. Are there any threats looming on the horizon? Well, yes, there are. One of them is the resurgence of bets on declining volatility in the options market. This is a concern because a forced unwinding of these positions as the VIX, the SIBO Volatility Index, surged, actually took part of the blame for the stock market's recent tumble on Tuesday. But what does this mean exactly? Let's break it down. When investors bet on declining volatility, they're essentially wagering that the stock market will remain stable or even grow. However, when something unexpected happens, like the hotter-than-anticipated inflation report that we saw on Tuesday, it can send the VIX, often referred to as Wall Street's fear gauge, skyrocketing. This sudden surge can force investors to rapidly unwind their positions, which in turn can lead to a significant market sell-off. It's like a domino effect. One small change can set off a chain of events that leads to a much larger impact. And this isn't just theoretical. We've seen it happen before. In fact, some analysts are fearing that we could be heading toward a repeat of the Volmageddon episode that rocked markets in 2018. During this event, a rapid increase in volatility led to a massive sell-off, causing significant disruption in the market. So, while the market has shown resilience so far, bouncing back from each dive with seemingly renewed vigor, these concerns over resurgent bets on declining volatility are not to be taken lightly. They represent a potential threat that could, under the right conditions, trigger another significant market downturn. It's important to remember, though, that while these threats are real, they're not cause for panic. Rather, they're a reminder that investing always carries some level of risk, and that staying informed and vigilant is key. While the market has shown resilience so far, investors must remain vigilant in the face of potential threats. So, what have we learned from this recent stock market roller coaster? In the blink of an eye, the market dove deep due to a hotter-than-expected January consumer price index. This unexpected surge forced investors to reconsider expectations for multiple quarter-point rate cuts by the Federal Reserve. What followed was a swift recovery, with the stocks reclaiming most of their losses within the next 48 hours. This resilience showed us that the market can bounce back from a sudden dive, proving that a delay in rate cuts isn't the catastrophe it was initially perceived as. We also witnessed the market's knee-jerk behavior, reacting strongly to data that runs too hot or too cold. While this reaction is understandable, it's important to remember that it might take a few more data releases to establish a new trend or to confirm whether this week's data was just a bump in the road. Furthermore, we learned about the bounce in stocks and the fall of the SIBO Volatility Index, or the VIX, a measure of expected S&P 500 volatility over the coming 30-day period. This sequence of events was quite illuminating, as it showed that if the fear of renewed inflation had been the driving force behind the stock drop, we wouldn't have seen the swift recovery or the quick drop in the VIX. However, looming on the horizon is the threat of Volmageddon, a term that recalls the market turmoil of 2018. This potential threat stems from resurgent bets on declining volatility via the options market. If these positions are forcibly unwound as the VIX surges, it could trigger another stock sell-off. The stock market is a complex entity, influenced by a multitude of factors. As investors, it's crucial to stay informed and adaptable in the face of constant change. Remember, our investment thesis for this year should not rely solely on whether the Fed cuts rates multiple times, but also on the belief that an expanding economy that doesn't fall into recession will perpetuate this bull market.